Last Friday, bond yields jumped on reports that the Chancellor had given up on the idea of increasing income tax. Now, until 2022, bond markets generally gave Britain the benefit of the doubt, and UK yields were pretty average by G7 standards. But since 2022, the UK has experienced what is technically known as a moron premium. This is the cost of markets lacking faith in the UK's long-term economic strategy. Rather than having rates around 3.5%, the UK faces bond yields of 4.5%. And this has big implications. It means the government needs to spend more on debt interest payments. The higher rates also encourage more saving rather than spending and crowd out private investment. Now, the UK's high rates are not just due to fears over debt. It also reflects the UK's high inflation and high interest rates. But the adverse reaction on Friday shows that markets do pay attention to strategy or lack thereof of a government tax and spending policy. Now, a rise in income tax will, of course, break manifesto commitments, but it would have raised nearly $9 billion a year. It collects from a wider source of payers and is less disruptive to growth than, say, higher national insurance contributions. In fact, there's a good case for replacing NI with just one income tax, which is broader based and less disruptive to employment, which of course has suffered a lot in recent months, slowing down the economy and contributing to that lower than tax expected revenues. Anyway, if the Chancellor could reduce this bond premium, there would be a really big benefit to the economy. The UK is forecast to spend £111 billion on debt interest payments this year. Now, the main reason for this big jump was at least partly due to higher bond yields in the past 2 or 3 years. And you could well say this is effectively wasted money. So much effort is going in to find an extra 20-30 billion, which ironically is fairly close to the amount that interest payments jumped in recent years. Now, recently, Andy Burnham said that the UK should become less in hock to the bond market, and it generated a predictable set of jokes like it would be very nice to become less in hock to my mortgage provider. Great in theory, not so easy in practice. However, what he really meant is that the fundamental problem the UK faces is that it has lost control over the cost of living and cost of spending. What we tend to forget about the Liz Truss crisis was that it was preceded by a jump in energy costs, which led to a generous government bailout of £50 billion. And then, of course, her tax cuts on top of that, when inflation was nearly 10%, caused the bond market to freak out, and the rest, as they say, is history. But even with gas prices falling, energy prices have remained stubbornly high. For many reasons, dating back decades, the UK has kind of lost control over energy prices, leading to some of the highest in the world. The UK energy market got all the costs of privatisation, with none of the benefits. Andy Burnham's point is that selling state-owned assets has increased living costs like anything. Case in point, the UK government used to spend money building social housing, keeping down housing costs. Now we can't afford to build houses because we spend that money on subsidising expensive private rents. Now, if you look at the reasons for the UK's exceptionally high inflation rate, it can be traced back to big jumps in bills, water, gas, electricity. And if you want to be less in hock to the bond market, reducing the cost of living would at least be a good place to start. And if we really want to understand what's going on with a fast-changing economy, it is very helpful to learn how to use artificial intelligence in a way that keeps us ahead of a fast-changing market, which is why I have teamed up with Outskill to bring you a 2-day live AI mastermind training, which has so far been attended by 10 million plus people globally. They're hosting a 2-day live AI workshop this Saturday and Sunday, 10 a.m. to 7 p.m. Now, usually this is a paid training worth $395, but Outskill are running their big Black Friday sale and offering all of my viewers a free seat in the training. I highly recommend you attend because not only do you get AI certified, but we'll also learn how to build AI-powered workflows, use AI tools, and eventually launch businesses which could generate close to $5,000 in weekly revenue. It's rated 4.9 out of 5 on Trustpilot, and you get trained by expert mentors from companies like Microsoft, OpenAI, Nvidia, and Google, people who've built the current AI landscape. In just 16 hours, you will learn 10 plus AI-powered tools, master AI in Excel, presentations, start building your own AI agents and workflows, and even join a community of AI builders inside their seamless learning dashboard. But wait, there's more. If you attend both days, you will unlock bonuses worth $5,000, including a prompt Bible, roadmap to monetize AI, and your own personalized AI toolkit. So if you're already planning your weekend, there's nothing more exciting than planning your future. Save your free spot now via the link in the description before the seats vanish. Now, you could easily make a case UK debt is not actually that bad. At 97% of GDP, it's not an outlier. In recent years, despite record levels of gilt sales, there has actually been quite strong demand. For all the talk of UK default, the bond market doesn't suggest anything like that in the near future. The UK does have higher interest rate costs, but it's nowhere near being like Argentina or Turkey. But the problem that the UK faces is not the odd 20 or 30 billion here and there, but the long-term projection of government spending and tax revenues, which require very real policy changes to avoid. Now, it is worth emphasising, if the government makes some sensible choices on tax and spending, this kind of debt projection can be avoided. But it is worth pointing out three things. Firstly, the UK interest rate is currently higher than the rate of economic growth. That makes fiscal consolidation much more difficult. The UK is very used to a growth rate above 2%. And we're struggling to cope with this new environment where real GDP per capita is virtually stagnant. Secondly, despite a parliamentary system which can give government a huge backbench majority, the government has failed to make any bold decisions which decisively change the narrative. They've managed to lose public support without even making any big change. Instead of a clear vision on tax rises or spending cuts or a combination, there's been a smorgasbord of small-scale efforts like winter fuel, inheritance tax on farmers, small benefit cuts. These have that unfortunate habit of annoying key groups, saving relatively little, and often have to be U-turned because of political pressure. The result is that fiscal policy is all a bit of a mess, characterised by uncertainty, lack of coherence, and complex tax fiddles end up hurting economic growth. And there's another problem too. The UK does have quite strong demand for gilt, but at least 30% of this is coming from overseas buyers. Now, Japan had debt of 240% of GDP, but it was largely funded by domestic savers, and also they had their own sovereign investment fund. So net debt was actually much lower. But the UK is relying very heavily on overseas investors, and this makes borrowing much more vulnerable to global events and a decline in the value of sterling. Now, at this point, some may say, forget the bond market, just get the Bank of England to create loads of money, buy the bonds, and start a massive extension of quantitative easing. Problem solved. We create our own currency, so make use of it to reduce borrowing costs and fund government spending. Now, this worked to some extent in 2009 when the economy was on its knees and the economy facing deflationary pressures. But when you already have an inflation of 3.8%, such an increase in the money supply risks even more inflation. Also, creating money to buy bonds from foreign investors will push down sterling, creating even more inflationary pressures and making it less attractive to save in the UK. Now, there is of course a case for the Bank of England to at the very least halt its policy of quantitative tightening. But you can't just fund all these future spending commitments by creating money out of thin air. Now, the bond market is not quite as powerful as some make it out to be. But the truth is, the Chancellor still needs the bond market to behave more than the bond market needs the Chancellor. And unfortunately, a likely scenario is that the budget will scrimp and save to meet fiscal rules with a very small headroom. But sometime in 2026, there will be some kind of shock to push up inflation, slow down growth, and then once again the fiscal rules will be stretched, causing people to speculate about where the next tax rises will come from. And uncertainty and speculation is exactly the kind of thing that the bond market doesn't like. And of course the sad thing is, it doesn't have to be like this. if you put aside for one moment manifesto commitments, which were made in haste, let us say, a rise in income tax combined with a more progressive council tax could easily raise £15 billion. And also the government shouldn't give up totally on the projected rise in government spending. Both pension and health-related benefits are soaring faster than GDP, which is not sustainable in the long term. Currently, a person on a combination of health-related benefits could receive an income around £25,000 or more. Of course, they could receive less depending on the benefits they get. But a full-time worker on the national minimum wage would have a take-home pay of around £23,800. That's 40 hours a week. And the rising number of health conditions has caused an explosion in benefit spending. Now, the government will hope that the Timms report will enable a way to at least slow down that growth in expected spending. And if benefit reform is based on structural improvements rather than panic cost savings like earlier this year, there is more of a chance of getting it passed in Parliament. So on the one hand, the UK does not face imminent default, far from it. But it is making a mess of fiscal policy, which is slowly storing up trouble for the future. But how would you fix a budget? This video lays out different options, how much they save, and all the pros and cons. So do check it out and let me know what you think. Thanks for watching. Do subscribe. See you soon.